Remember to subscribe to help Steve-O out, and I will keep making more sleepy stories. Tonight, we are staying in Unit 3 Accounting, Area of Study 2. In the last episode, we interpreted accounting reports and thought about what the numbers were trying to say. We looked at profit, liquidity, stability, efficiency, inventory, cash flow, financial indicators, and non-financial information. Tonight, we take one more calm step before Unit 3 comes to rest. We are going to think about ethical decisions and accounting analysis. This means we are not only asking whether the reports have been prepared correctly, we are asking whether the information is useful, whether it is honest, whether it represents the business faithfully, whether the owner can rely on it when making decisions, and whether the choices made by the accountant, the bookkeeper, or the business owner are fair, responsible, and clear. You might picture a small trading business at the end of the month. The shop is closed. The lights are soft. The computer screen glows quietly on the desk. A stack of source documents rests beside the keyboard. There are invoices, receipts, bank statements, inventory records, and a few handwritten notes from the owner. On the screen, the income statement, balance sheet, and cash flow statement are open. The numbers are still. But behind the numbers, there are decisions. There are choices about what to record, when to record it, how to value inventory, how to treat debts, how to report expenses, and how honestly the reports should tell the story of the business. That is the calm heart of this episode. Accounting is not just calculation. Accounting is information for decision-making, and because people rely on that information, accounting also involves ethics. So, let us begin slowly. An ethical decision is a decision that considers what is honest, fair, responsible, and appropriate, not just what is easiest or most beneficial in the short term. In accounting, ethical decision-making matters because accounting reports can influence real choices. An owner may decide whether to expand the business, borrow money, reduce expenses, change prices, buy more inventory, employ another staff member, or close part of the business. A bank may look at reports before lending money. A supplier may look at payment history before offering credit. Even staff, customers, and the wider community may be affected by the way a business is recorded and managed. So the information should not be deliberately misleading. It should not hide problems. It should not make the business look healthier than it really is, and it should not be changed simply because the owner wants a more comfortable answer. In VCE accounting, this idea connects closely to the qualitative characteristics of accounting information. Qualitative characteristics are the features that make accounting information useful. They help us judge whether the information in reports is suitable for decision-making. One of the most important is relevance. Relevant information is information that can influence a decision. It helps the owner predict future outcomes, confirm past decisions, or choose between alternatives. For example, if a trading business is deciding whether to keep selling a particular item of inventory, the owner needs relevant information about sales, cost of sales, gross profit, inventory turnover, customer demand, and possible selling price. If the information does not help with the decision, it may be interesting, but it is not very useful. Relevance asks a simple question. Will this information help the user make a better decision? Another key qualitative characteristic is faithful representation. Faithful representation means the accounting information should represent the real economic events of the business as accurately and honestly as possible. It should be complete, it should be neutral, and it should be free from material error. Complete information includes the details needed for the user to understand what has happened. Neutral information is not deliberately biased to make the business look better or worse. Information that is free from material error does not contain significant mistakes that would affect decision-making. This is where ethics becomes very practical. If an owner leaves out an unpaid expense to make profit look higher, the report is not faithfully represented. If damaged inventory is kept at its original cost, even though it can only be sold for less, the value of inventory may be overstated. If a personal purchase by the owner is recorded as a business expense, the reports may mislead users about the true expenses of the business. A strong accounting answer should be able to explain both the accounting effect and the ethical issue. For example, if damaged inventory is not written down to its net realizable value, assets and owner's equity may be overstated, and the report may not faithfully represent the value of resources controlled by the business. That is stronger than simply saying that the owner did the wrong thing. It links the issue to the reports and to decision-making. Other qualitative characteristics also matter. Comparability means users can compare accounting information between reporting periods or between similar businesses. For example, if the same method of depreciation is used consistently, it is easier to compare profit from one period to another. If methods are changed without a clear reason, performance may appear to improve or decline when the real reason is only a change in accounting treatment. Verifiability means the information can be checked using evidence. Source documents, bank statements, inventory records, and calculations help another person confirm that the information is reasonable. Timeliness means information is available in time to influence decisions. A perfect report prepared 6 months too late may not help an owner fix a current cash flow problem. Understandability means information should be presented clearly enough that users with reasonable accounting knowledge can interpret it. This does not mean the information is oversimplified. It means it is organized, labeled, and explained so the owner can use it. Now let us connect these characteristics to accounting assumptions. Accounting assumptions are basic rules or ideas that guide the way accounting information is recorded and reported. One important assumption is the entity assumption. The entity assumption says that the business is treated as separate from the owner. Even if the owner controls the business records should only include business transactions. This is why drawings are recorded separately from business expenses. If the owner takes inventory for personal use, that is not a sale to a customer, and it is not a business expense. It is drawings. If the owner pays for a personal holiday from the business bank account and records it as advertising, the reports do not faithfully represent the business. The entity assumption has been broken. Another assumption is the accrual basis assumption. Under accrual accounting, revenues are recognized when they are earned, and expenses are recognized when they are incurred, not simply when cash is received or paid. This matters because profit and cash are not the same thing. A business may make credit sales and earn revenue before receiving cash. A business may use electricity in one period and pay the bill later. Accrual accounting helps the reports show the financial performance of the period more accurately. The period assumption says that the life of the business is divided into reporting periods, such as months, quarters, or years. This allows the owner to measure performance over a specific time. It also means that some items must be adjusted at the end of the period, so revenues and expenses are reported in the correct period. The going concern assumption says that the business is expected to continue operating into the foreseeable future. This allows assets such as equipment to be reported and depreciated over their useful life, rather than treated as if the business will close tomorrow. These assumptions may sound simple, but they shape many accounting choices. In a VCE accounting response, you may need to explain why a transaction has been treated in a certain way by linking it to an assumption or a qualitative characteristic. Now let us think about internal controls. Internal controls are procedures used by a business to protect assets, reduce errors, prevent fraud, and support reliable accounting information. They are quiet safeguards inside the accounting system. They help the owner trust the records. For a small trading business, internal controls might include checking source documents before recording transactions. They might include numbering invoices so missing documents can be detected. They might include locking cash in a safe, using passwords for accounting software, keeping inventory in a secure storeroom, or comparing the bank statement with the cash at bank account. They might include separating duties, so the same person is not responsible for receiving cash, recording cash, and banking cash without any checks. They might include authorization procedures, where large purchases must be approved by the owner before they are made. Good internal controls support faithful representation because they make errors and dishonest behavior less likely. They also support verifiability because transactions can be traced back to evidence. But internal controls are not perfect. They can be ignored, overridden, poorly designed, or too expensive for a small business to use fully. So a strong exam answer may discuss both the benefit and the limitation. For example, requiring the owner to authorize all credit purchases may reduce unnecessary spending, but it may slow the purchasing process if the owner is unavailable. Now imagine a small business owner looking at the end-of-period reports. The profit is lower than expected. There are several accounts receivable that may not be collected. Some inventory is damaged and may need to be sold at a reduced price. The owner is tempted to leave the doubtful debts alone and keep the inventory at its original value. This would make the reports look stronger, but it would not make the business stronger. It would only make the reports less honest. If accounts receivable are unlikely to be collected, the owner should consider the impact on assets and profit. If inventory cannot be sold for its recorded cost, the owner should consider whether its value needs to be adjusted. The ethical issue is that overstating assets may mislead users about the financial position of the business. The accounting issue is that the reports may not provide relevant and faithfully represented information for decision-making. This is where accounting analysis becomes more than calculation. The owner needs to ask what the numbers mean and whether the records tell the truth clearly enough. In Unit 3, exam questions often reward clear linking language. A weak answer might say, "This is unethical." A stronger answer explains why. For example, if the owner deliberately fails to record an expense, net profit will be overstated and owner's equity will also be overstated. This reduces faithful representation because the report is biased and does not completely show the expenses incurred during the period. As a result, the owner may make poor decisions based on inaccurate profit information. That answer links the ethical issue, the accounting effect, the qualitative characteristic, and the decision-making consequence. That is the pattern to remember. Ethical issue. Accounting effect. Qualitative characteristic or assumption. Impact on decision-making. Let us try another example. Suppose the owner uses business cash to buy a personal laptop for home use and records it as office equipment. The entity assumption is affected because the transaction is personal, not business-related. Assets may be overstated if the business does not control the laptop for business use. Profit may be affected later through depreciation expense that should not be recorded by the business. The reports may not faithfully represent the financial position of the business, and the owner may misunderstand how much has really been invested in business resources. Now, another example. Suppose an accountant delays recording a supplier invoice until the next reporting period, so that expenses look lower in the current period. Under accrual accounting, the expense should be recognized when it is incurred. If it is delayed, expenses are understated, profit is overstated, and liabilities may be understated. This affects faithful representation and may make the business appear more profitable and less indebted than it really is. Again, the strongest answer does not only describe the behavior, it explains the consequence. Now, let us think about non-financial information. Accounting analysis should not rely only on numbers. A business might have improving profit but declining customer satisfaction. It might have strong sales but high staff turnover. It might have good inventory turnover but many customer complaints about product quality. It might reduce expenses by cutting staff training, but this could damage service quality in the future. Ethical decision-making often requires both financial and non-financial information. For example, choosing a cheaper supplier may improve profit in the short term. But if the supplier uses poor labor practices, produces low-quality goods, or causes long delivery delays, the decision may harm the business and conflict with social responsibility. An owner should consider profit, cash flow, customer relationships, staff well-being, supplier reliability, environmental impact, and long-term reputation. This is why accounting advice should be balanced. A recommendation should not simply say, choose the option with the highest profit. It should consider whether the option is sustainable, ethical, and suitable for the business goals. Now picture the quiet office again. The owner sits with the reports. There is a pencil beside the income statement. There is a calculator near the balance sheet. There are inventory records, customer account records, and a bank reconciliation waiting to be checked. Everything is still, but the decisions matter. The reports help the owner see what has happened. The qualitative characteristics help the owner judge whether the information is useful. The accounting assumptions help the owner record events consistently. Internal controls help protect the reliability of the records. And ethics reminds the owner that accounting should not only be technically correct, it should also be honest. For exam purposes, it can help to use a calm structure when answering ethical or analytical questions. First, identify the issue in the scenario. Second, state the accounting effect on assets, liabilities, owner's equity, revenues, expenses, profit, or cash flow. Third, link the issue to a qualitative characteristic, accounting assumption, internal control, or ethical principle. Fourth, explain how this affects decision-making by the owner or another user. And if the question asks for advice, give a clear recommendation supported by accounting evidence. For example, the owner should write down damaged inventory to its net realizable value because this provides a more faithful representation of the value of inventory and prevents assets and owner's equity from being overstated. Or, the owner should improve internal controls over cash receipts by numbering receipts and reconciling records with bank deposits, because this reduces the risk of errors or theft and improves the reliability of accounting information. Or, the owner should not record personal expenses as business expenses because this breaches the entity assumption and makes the reports less useful for judging business performance. These are the kinds of links that turn accounting knowledge into accounting analysis. So, as Unit 3 settles now, remember the quiet pattern. Accounting records begin with evidence. They move through journals and ledgers. They become reports. Reports are interpreted. And then the information is used to make decisions. But every step depends on trust. The trust that the records are based on real source documents. The trust that transactions are classified properly. The trust that reports are relevant, faithfully represented, comparable, verifiable, timely, and understandable. The trust that the business is separate from the owner. The trust that revenues and expenses belong in the correct period. The trust that internal controls are helping protect the records. And the trust that ethical choices are being made when the answer is not simply mechanical. That is accounting tonight. Not only numbers, not only reports, but careful information used responsibly so that a business owner can make better decisions. Let the office lights dim now. Let the reports close softly. Let the calculator rest. And let the final idea stay simple in your mind. Good accounting should help people see the business clearly. And clear information, used ethically, leads to better decisions. This has been Sleepy Steve. Sleep well and let the accounting analysis settle quietly in your mind.